This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and we are here to help you make sense out of all of the various decisions that have anything and everything to do with your dollars. On tap today, as is always the case, a variety of topics. We'll talk about an interesting article that we saw in the Wall Street Journal yesterday, and talking about the fact that sometimes, in our opinion, more often than not, that Roth IRA may not be your best decision. It seems like certainly the crowd or the general misconception, the mass media approach is to push the Roth, but what you should always do anytime you make an investing decision is to run the numbers and to actually consider the alternatives. Don't get so hung up on it that you jump at the notion of tax-free. So a good article. So we'll talk about some of the reasons and some of the situations where you really don't want to jump on that Roth. You want to continue on the more traditional side and do it on a pre-tax basis. We'll also shift gears. I know last week we were talking about the start of school. Now that school has started and we're getting, I guess, close to fall, where I grew up in Maine, the end of summer, the start of school was always sort of the end of summer. But now here in Florida, school starts in mid-August, and so it's really hard to say that it's the start of fall when it's still the middle of August, which is traditionally summer. But anyway, clearly we're getting closer to fall, and certainly this year the focus is going to be shifting to politics. So we'll talk a little bit about that and some of the perspective that we have, particularly this year that is a midterm election year, and we'll chat a little bit about that and what to expect from the markets as well during a midterm election year. And then we'll also, of course, do our recap, which we always do. And that's sort of what we've got on tap for today's program, which means that we always have room for your topic. So if you would like to add your topic into the mix, you can do that in one of two ways. You can pick up the phone and dial into the radio studio, 407-916-5400, toll-free 1-855-545-1025, or you can send us an email. That email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. So Nelson, Nelson, financialplanning.com. That's how you can get in touch with us and add your topic into the mix, if you will. And before we get to all of that, we wanted to take a moment and, so to a certain extent, pat our own back a little bit, but also let you know what the latest is with our little firm, Nelson Financial Planning. So we were announced as a finalist for the 2018 State of Florida Companies to Watch, which is pretty cool, or at least we thought it was pretty cool. It is a program that is put on by Grow Florida, and it is developed by the Edward Lowe Foundation. And the Florida Companies to Watch program is an award program that looks for businesses that are sort of in the second stage, not really just starting out, but have reached a bit of a critical mass. And it seeks businesses from, kind of all different industries, representing kind of all areas of the state, and looks for projected past success, projected success, and sort of the reputation of the company themselves, and then they are deemed to be one of the Florida companies to watch. So we will go through the next round of the process, and so keep your fingers crossed. We'll keep you posted on that, but certainly we're very proud and very honored to have been named one of the 2018 Florida Companies to Watch finalists, and certainly want to take a moment to thank our clients for that, because without them and their continued confidence and trust and loyalty and referrals and relationships that we have with them, we obviously would not be even in the running for this kind of an award. So it is an award certainly for the firm, Nelson Financial Planning, but it is also an award that goes directly to all of our awesome clients. We're very fortunate to work with a wide range of people. It makes my day a lot of fun every day, getting to work with such a broad spectrum of folks, and we're very fortunate and very blessed to have had some measure of success with that, and obviously to be named a finalist for this statewide award. That's certainly pretty cool. So good stuff there. And we will keep you posted on kind of the next round. I guess we are a finalist now, and I guess the next round will determine whether we actually kind of win the official award. So that's good. Matter of fact, after this show, I go into the office to work on that application process, which why I was running a few minutes late this morning is because I was working on that at the house. But anyway, so we'll keep you posted on that. So that's certainly pretty cool. We also did mention that in a letter to our clients that we sent out late last week, sort of our late summer type of newsletter announcing our events for the fall. We've got a couple of client meetings, as we do every quarter. So we were announcing some dates for the fall, and also talking a little bit about the markets as well. So when we get back from the break, we'll share with you a little bit about what that letter said, and we'll continue on with the topics that we talked about at the top of the hour. So stay tuned for all that here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning, a finalist for the 2018 Florida Companies to Watch program. So that's pretty cool. We're excited about that. So now that we've started school, I guess it's traditionally fall, although it's still mid-August here in Central Florida, we now turn our attention to the elections. And those are rapidly coming up. And so far, as we said in the letter we sent out to our clients late last week, it's been a bit of a seesaw in the market. Depending upon the month, depending upon the headline, it's been either a good month or a bad month or an indifferent month. And so the market so far in 2018 has generally been, kind of trending a little bit sideways of late, particularly over the past few weeks as we've been going through earnings season. We've seen it sort of start to turn upward. So it is up a little bit, 3, 4, 5% is the return so far this year. And so certainly nothing wrong with that by any stretch of the imagination. But there does seem to be this interplay, if you will, between the economic data, which obviously is coming out very strongly, and corporate earnings, which are coming out also very strongly, and the specter, if you will, of the Federal Reserve and raising interest rates, and are they going to raise those rates too fast? Now, what's interesting about that concern is that, at least based upon what they've been doing, they've been acting pretty conservatively. So I don't. It's one of those things where you kind of scratch your head a little bit about, why is everybody concerned that, oh my goodness, they may start raising interest rates too quickly, and that, and that would serve to be a bit of a drag on the economy, when they really haven't been raising rates all that fast at all. I mean, they've been very conservative on it, and we think that trend will continue, but it is contributing to a bit of a yin and the yang, a seesaw, a playground seesaw, if you will, is how we described it in our letter, that sort of goes back and forth and back and forth. So the other part that is sort of overlaying on this is of course the midterms, and I think we talked about some of the statistics on that probably a month or so ago. Certainly do bear repeating. I mean, if you look at midterm election years and the markets, what's interesting is that usually the first 3 quarters are relatively quiet, and then once the midterm elections get resolved, then you wind up having a market that sort of applauds that and leads directly into that third presidential year, which, in case you forget, the third presidential year is consistently sort of one of the stronger ones historically for performance. If you look at performance versus versus the year of a president cycle, then the first 2 years are usually weaker than the third and fourth year. After the midterm elections, then you wind up sort of getting a little bit more of a market bump in those third and fourth years of a presidential term, simply because you've got the uncertainty of midterms and potential legislation behind you, and you ultimately wind up with a because of that political uncertainty that's now off the table. Politics returns to normal, which is, unfortunately, usually spells gridlock. There has not been a negative third year of a president's term since 1939, which would have been just prior to everybody, getting into World War II and those kinds of things. And certainly it appears that we will be very much in a gridlock scenario in Washington. Well, first of all, even though Republicans control House and the Senate. There's so many different flavors of Republicans these days that they're not exactly voting as a block. Now there's been much conversation in the media about Democrats may be able to flip Congress. I think now if you sort of kind of look at where things are, that would be a bit of a long shot, particularly in the Senate side. The Republicans don't really have to defend in more balanced districts or more balanced states. On the Senate side, they don't really have to defend much. The Democrats do have to defend some seats that are starting to look competitive, particularly in toss-up states, like, for example, here in Florida. The Senate race here in Florida features an incumbent Democrat against a Republican, and that seems to be at this point, and obviously we're a bit a ways from Election Day, but somewhat of a bit of a toss-up. I mean, it's not clear. There's no clear favorite if you kind of look at the polls at this point. So some of the current reading of the tea leaves is that the Republicans may, in fact, increase their control in the Senate by one or two, just given the dynamics of what the Democrats have to defend and what the Republicans don't on the Senate side. In the House side, because of all this silly political gerrymandering that's happened over the years, there's very few sort of toss-up districts, and if you think of it, that may be part of the problem with politics these days, is that very few centrist candidates can emerge because your district is either Democrat leaning or it's Republican leaning, and you have to kind of go to the base, if you will. Which is why I always get the impression these days in Washington that everybody is a firm sort of has a firm ideology, and they don't really waver from it. And I'm sure politics and money and party and all that kind of stuff come into play as well on that. But if you're looking at the makeup of sort of those real, what you would consider those toss-up districts, there's only 36 of them, and that's kind of surprising when you look at all of the different House districts that exist. Is 435. You only got 36 that are considered more toss-up in nature. The Democrats would have to win 23 of those 36. In order to flip the House, so that, I mean, that's doable. I mean, that's not you don't have to run the table, but 23 to 36 isn't necessarily a slam dunk. Particularly, if you look traditionally, people sort of vote their wallets, and right now with the economy running as well as it is and unemployment low, you've got the what I would say is the wallet effect as a bit of a wind in your sail on the Republican side of things. But the Democrats would have to go 23 to 36, which is a bit of a not easy, if you will. So, but bottom line on that is that you would wind up with much more of the same, much more on the gridlock side. The important thing is that you wind up getting resolution going into the third year. And if you look at data going back 100 years, what's interesting is that stocks rise 87% of the time in each of the 3 quarters that follow a midterm. 87%. That's pretty good. That's a pretty good track record. So certainly there is something about these midterm elections and the market, and when you get through the midterm elections and you get a resolution, if you will, and then that leads into the historically stronger years in a presidential election cycle anyway for the market, the third and the fourth year. Certainly having the statistics show that you got an 87% likelihood that the markets respond pretty positively in the quarters that follow midterm. That's certainly some pretty interesting data. That is for sure, because when you look at the economy and the markets right now, they have been kind of going a little sideways, if you will, on a seesaw battle. But perhaps these midterms will get that back and forth resolved to just move upward. And certainly the statistics on that at 87% would suggest that. So obviously stay tuned on that. We'll have much more on that topic in the weeks ahead as we lead up to the midterms. But we thought interesting to kind of chat a little bit about that with sort of the start of school, and then that means it's the fall, and then that means it's election, and where are the tea leaves reading in terms of Congress. So some interesting kind of numbers on that. We will be back after this. We'll talk a little bit when we get back. We'll talk a little bit about this past week in the market, and then also IRAs versus Roth. So stay tuned on that here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is Joel Garris of Nelson Financial Planning. One last kind of side comment on politics that we were talking about in the last segment. You know those guys get like 13 weeks of vacation. It's like 3 months. I mean, I'm just curious how many other folks get 13 weeks of vacation, particularly when one could certainly argue that the job that they're doing is not particularly good. Seems to me that if I'm not doing a particularly good job, I shouldn't be getting 13 weeks of vacation. Maybe I should be spending more time in Washington figuring out, how do I balance the checkbook? Well, maybe that might be a good way to spend the time. But, hey, I'm just one person here in Central Florida, a little jealous of 13 weeks of vacation. 13 weeks? Yeah, that's what those guys get. Man, no wonder once those folks get in, they never want to leave. It's too easy of a job. Anyway, we'll shift gears, talk a little bit about the week that was. So headline-wise, you heard a lot about, you're probably more about Turkey this past week than you do unless it's Thanksgiving week, for crying out loud. But Turkey made some headlines, the country, not the bird. And obviously their approach, Turkey kind of has been modeling itself on sort of the China approach, which is, borrow, build, and that will help to move your economy along. And the problem with that is that Turkey is not China, and China has a lot more clout and size of its economy, and Turkey does not. And so what has happened there is that Turkey has become over-leveraged. That's a recurring theme throughout history now, isn't it? If you borrow too much money, it doesn't matter whether you're a country or an individual. Bad things can happen. And so that's kind of all been what the headlines have been about on Turkey. The tariff conversation as well has hurt them also. So that kind of was the big big kind of conversation, the big headline, if you will, this past week, along with Walmart. Who knew that? Well, I think if you follow Walmart carefully, you know that they have been fighting very hard against the Amazon behemoth, and it appears that they, in fact, are starting to make some traction. So that certainly made a bit of a splash this past week, contributed to a pretty significant day on the Dow on Thursday. We actually had a couple of conversations with folks of yes, one stock can in fact propel the Dow a bit more significantly than what's happening in the overall markets, and certainly that was the case on Thursday, where you have kind of that one company and those results starting to kind of really drive things. So for the week, the Dow was up over about almost close to 1.5%. But if you look at sort of the broad-based market, the broad-based market was not up as much during that period of time. The broad-based market last week was only up, as measured by the S&P 500, was only up about 0.5 point. So a bit of a split, if you will. Remember, the Dow is 30 companies, and the S&P 500 is 500 companies. So your more accurate result of the overall market is going to be through the S&P 500. Certainly a bit of a gap with the Dow up about 1.5% versus the overall market's up about 0.5%. But again, decent week if you're keeping score at home, and a lot of that is still continues on to the earnings season. Although that is certainly starting to wind down. In the week ahead, the only real the biggest piece of economic data coming out is the Federal Reserve and the minutes and that they release. During the meeting that they had, they released the minutes a couple of weeks after, so they're releasing the minutes, and usually that generates some kind of a reaction or an analysis by the by the overall market. So. Stay tuned on that portion as well. Earnings season has just about, for the second quarter, has just about wrapped up. There's a handful of companies left, but for the most part, that is very much wrapped up. So at the beginning of the program, we talked a little bit about this great article in the Wall Street Journal this weekend about, and it is entitled, and I love the title, "When to Ignore the Crowd and Shun a Roth IRA." Now, this has been a very, very favorite topic of ours for probably decades on this radio program, going back to when my father-in-law, Jack Nelson, used to host the program. We never have been overly big fans of the Roth, and I think the industry as a whole likes to talk about the Roth because it's tax-free, and anytime you can use those words, it's free, then that will probably generate out some more excitement. And so the industry has really kind of latched on to the Roth and the free nature of it to have that be one of the main talking points. And in our mind, you really have to run the numbers and do the analysis. Don't make the choice between pre-tax, which is what you would have with an IRA, versus post-tax, which is what you would have with a Roth. Don't forget to run that full analysis. Okay, if the IRA is pre-tax, that means I save taxes now. Yes, when I take it out, I have to pay taxes. The Roth, I pay taxes now. I put the money in, and then when I take it out, it's free from taxes at that point. Don't let that last free part determine the entire analysis of which one is right for you, because it really does involve looking at your taxes, looking at your tax rate, and then looking at the future and what that might be. And interestingly, for most people, your tax rate in retirement is not going to go up. Stop and think about that for just a second. Because when you retire, the goal is always to try and basically match your current income. So that's not going to be higher, right? I suppose it could be, but you also could have retired earlier. So that's probably a nice flexible choice that you did. But the notion that your taxes are going higher in retirement usually doesn't play out, because oftentimes when you get to retirement and you start to draw income, you will be able to draw income from a variety of sources, many of which do not face the same tax consequence that your current paycheck does. Your current paycheck is subject to nearly an 8% tax for Medicare, Medicaid. You don't have to do that in retirement. Your current your current income is 100% taxable. Social Security, when you receive that, is never 100% taxable. Yes, it is taxable up to a maximum of 85%, but that means that 15% of it is still coming to you on a tax-free basis. So the couple of big points to consider is that, well, wait a minute, if 15% of my Social Security is tax-free, and then I don't have to worry about the 8% tax that I would have paid on Medicare, Medicaid, and retirement, then effectively I'm going to have the same level of income as I did when I was working with less actual dollars. And if I have less actual dollars, then that means that on my tax return, my income goes down. You see how that kind of works. Specifically, this article talks a lot about conversions, and that's also where I have a lot of indigestion as well. There's been $75 billion converted from traditional IRAs to Roths since the year 2010. So over the course of the past 8 years, it's $75 billion that's been converted. If we assume a 25% tax rate on that $75 billion, then that's a healthy 20-odd billion, or close to 20 billion, that wound up going to the IRS. Wonder what they did with that extra 20 billion. Anyway, 20 billion. So there was enough people out there since 2010 that elected to send in an extra 20 billion to the government when they didn't really have to. Interesting. We'll talk about some of the other factors on what goes into those decisions and why you may want to reconsider it when we get back here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. Talking a little bit about IRAs versus Roths, and in this segment we'll talk specifically about conversions because there's been $75 billion converted from traditional IRA to Roth since 2010. So that's about $20 billion in taxes that Americans paid voluntarily, taxes that they did not have to pay, but they elected to pay because they got caught up in the tax-free sales pitch of the Roth. Now, let me be very clear as I start this topic. There are certainly times when that makes sense. The vast majority of the time, though, it does not. And the circumstances are more often than not that making the conversion just doesn't make sense. Because, as we were talking about in the last segment, it doesn't make sense if you're going to reduce down, if your tax rate is going to go down. It also doesn't make sense when you look at the ripple effect that this additional income can have. I'm reminded of an email that we got that we shared on air a few weeks back, where someone was looking at doing a conversion because they were in a low tax rate. They were in the new, for this year, it's that lower tax rate is 12%. And they said, oh, well, if I can do it at 12, then yeah, that's a pretty good idea. But what they neglected to include in the mix was the fact that the additional income that comes from a conversion, because when you convert an IRA to a Roth, you have to report the amount that you're converting as ordinary income on your tax return and then pay taxes on that. In this person's case, when they did that, had that additional income, it triggered additional taxation on their Social Security. So instead of it costing them 12%, it was more like 22%. Now, that will make you stop and hesitate, because if you're in the 12% tax bracket, why are you going to do something and you're going to be paying at 22%? So it really does require a full analysis on the tax implications. More often than not, it's going to cost you more than you realize. The other thing, too, on this is you then wind up having to pay the taxes, right? So you've got taxes to pay on that conversion. Where are you going to get the money from? Well, you can't use the money inside the IRA to pay the taxes, because then that means you're converting and winding up with less money. And so it's always better to use outside money to make the conversion happen. Well, if you're using outside money, guess what? That means you're having to use some of your savings, and perhaps you could use that savings for other things other than sending a check into the government. If you're younger and doing the conversion, and you really can't use that money inside the IRA to pay the taxes, because if you're under 59 and a half, then you would have a 10% penalty on that portion that you actually kept to pay the taxes. So just be aware of the other part, which is, okay, well, how do I pay the taxes on it? Here's the other kicker. Let's say you did that conversion at the beginning of 2008. How'd that work out? You converted, your account had $100,000 in it. You converted, you had to pay $100,000. You had to report the $100,000 as income, because that's how much you converted. And then the market went down. Your account, if it was invested in equities, it was, down 30 or 35%. So, but you still have to pay taxes at the $100,000. That's another thing that, that can really make that conversion pretty tough to swallow. Now, there were back then ways to unwind that. Those ways are gone. So you have to be very careful of how that plays out, given the complexities of the tax system. The other thing too is that on a conversion, you really need to have time on those assets. I mean, if you're retired and doing a conversion, then you almost have to sort of leave those Roth assets alone in order to really be able to get the compounding of that benefit of that conversion. Because you want as much growth in that Roth account as possible, because then all of it comes out tax-free. Well, how do you get as much growth as possible? Well, you give it as much time as possible. So certainly some things to kind of think about. There's also some other tax ripples that occur, particularly with medical expenses. Oftentimes, if people have large medical expenses, you're able to use those and to get above the threshold and ultimately offset ordinary income that you would be having to pay if the money was coming out of the IRA. And then if you do have kids in college and you do the conversion, then obviously that's a spike in your income, which would certainly affect financial aid as well. So just the bottom line, as with any financial decision that you're making, make sure you run the numbers, make sure you look at all the alternatives, and really put pen to paper to really see what actually makes the best sense. I think far too often the financial media is really pushing the tax-free, and people don't stop and do the analysis as to what really makes sense. So that's our final thought for the program, and thank you all for listening. We will be back next week, as we are each and every week. You've been listening to Dollars and Cents with your host, Joel Garris, News Radio 102.5 WFLA.
Of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.